Headquartered in Shanghai, known for designing and developing electric vehicles, autonomous driving systems, and battery-swapping technology. Founded in 2014, NIO emerged as one of China's most ambitious EV startups, often labeled as the Tesla of China. It distinguishes itself through unique services like Battery as a Service, BaaS, allowing customers to swap batteries in minutes instead of waiting to recharge. Over the years, NIO has expanded its offerings across multiple electric SUV and sedan platforms, including the ES6, ES8, and ET7. Its business strategy targets high-end consumers with premium features like autonomous driving packages and in-car AI assistance. Recently, NIO has doubled down on international expansion, particularly in Europe, launching operations in Norway and Germany. In July 2024, NIO unveiled its new smartphone, designed to integrate deeply with its EV ecosystem, an unusual but potentially sticky move into consumer electronics. Despite this innovation, NIO's journey hasn't been without turbulence. Like many Chinese equities, it has faced macroeconomic headwinds, regulatory challenges, and competition from rivals like BYD, XPeng, and global giant Tesla. Analyst Insight Dan Ives from Wedbush Securities recently noted that NIO's vertical ecosystem and software ambitions could drive long-term differentiation, but near-term execution is key amid growing pressure from domestic peers. That sentiment captures both the optimism and caution surrounding NIO's trajectory. As of mid-July 2025, NIO is trading around $4.50 USD, significantly below its 2021 peak above $60. Its current market cap sits at just over $8 billion, a stark contrast from its former valuation highs. NIO's Q2 2025 earnings revealed a revenue of $1.4 billion, slightly under expectations. But it delivered a notable 14% quarter-over-quarter increase in vehicle deliveries, now standing at over 190,000 units for the year. However, the company remains unprofitable, with a net loss of over $600 million this quarter. Much of that loss is driven by aggressive R&D and overseas expansion, something investors must closely watch. Its gross margin is just 1.5%, which is razor-thin in the EV space and indicates tough pricing competition. NIO has over $5 billion in cash and equivalents, thanks in part to capital raises and Chinese state-backed investment arms. However, the company continues to burn through capital, especially as it scales infrastructure and its battery swap stations. One bright spot? Its strategic partnership with CATL for next-gen batteries and ongoing cooperation with state energy providers may give it an edge in EV range and charge speed over time. NIO is part of the broader Chinese EV boom, fueled by ambitious carbon-neutral targets and heavy subsidies. However, this landscape is brutally competitive. Brands like BYD, Li Auto, and XPeng continue to eat into NIO's market share, while global legacy automakers like Volkswagen and BMW expand EV offerings in China. While NIO's battery-swapping infrastructure is unique, it's expensive and challenging to scale. The company now operates over 2,300 swap stations in China and is expanding them in Europe. But competitors are betting on ultra-fast charging instead, potentially leapfrogging NIO's model if charging tech progresses rapidly. Meanwhile, Tesla continues to undercut NIO on pricing while maintaining strong brand equity. Unlike NIO, Tesla already operates profitably in China and holds significant mindshare. On the tech front, NIO is investing heavily in autonomous driving and has launched NOP+, its Navigate on Pilot system. This tech will be crucial for future brand differentiation, but full self-driving still faces legal and technical hurdles in both China and Europe. NIO's international push, including new showrooms and service centers in Norway and Germany, is impressive, but adoption remains slow relative to expectations. NIO's stock has been on a roller coaster. From its IPO in 2018 at just over $6 per share, it exploded during the 2020-2021 EV bull run to highs near $66. Since then, it's seen a prolonged decline. While the 12-month trend is mostly bearish, volume has been increasing, suggesting renewed investor interest, possibly speculative. Long-term holders are now watching to see if $4 acts as a firm base, with potential upside tied to macro trends, EV sentiment, and future earnings surprises. Many chart analysts cite NIO's current price range as historical support. with resistance around $6.50 and key breakout thresholds near $9. What's notable? Despite underperformance, NIO remains one of the most actively traded EV tickers on retail platforms, which means any bullish catalyst, whether news-driven or speculative, can spark a major upside swing. Retail sentiment toward NIO is polarizing. Bullish retail investors argue that NIO's ecosystem, battery swapping model, and software innovation give it long-term edge. Many also see the company as undervalued, trading at less than 1x sales, and cite parallels with Tesla's pre-profitability phase. On platforms like Reddit and StockTwits, buy-the-dip sentiment remains common. However, some investors have grown frustrated with the stock's volatility and dilution risk. From the analyst side, opinions are mixed. Morgan Stanley has a neutral rating, citing high potential but limited visibility into profitability. Goldman Sachs recently reiterated a sell, arguing that NIO's cash burn and margin compression raise concerns over sustainability. Citi remains cautiously bullish, placing a $10 price target and noting that investor patience may be rewarded over a 2-3 year window. The market consensus is currently hold, with 8 of 22 analysts calling it a buy, 11 a hold, and 3 a sell. What's clear is that short-term upside will depend on clear progress toward profitability, delivery momentum, and global expansion metrics.